Welcome to enrichedminds.com and our session on GDP and taxes. Both of these topics have to do with macroeconomics as well, but we shall try and keep it simple and focus on how it matters to you as an individual. So let's get started. In this session, you will learn about what GDP is and why it is important to understand this topic. We shall also discuss the importance and need for taxes and how it impacts us. First, GDP, or the gross domestic product of a country. Gross domestic product is a monetary measure of the market value of all the final goods and services produced in a specific time period by countries. Let's get started with a short video courtesy of CNBC.
How do you measure the size of an entire economy? Let's say I buy a coffee here in London for £3. Those £3 are factored into the United Kingdom's GDP. And so is this barista's salary and this espresso machine. In fact, most of what's around you is part of GDP. GDP is an important gauge of the overall health of an economy. It stands for Gross Domestic Product. Simply put, GDP measures the total value of all goods and services in a country. That means it measures a lot of stuff worth a lot of money. Here in the UK, GDP is around $2.5 trillion per year. In the United States, the world's biggest economy, it's around $19 trillion every year. How do you get to these numbers? Well, you can calculate GDP in a few different ways, but the most commonly used equation goes like this. Consumption plus investment plus government spending plus net exports equals GDP. Let's break that down. Consumption is another way of saying consumer spending. It's the money you or I spend on physical goods like coffee and on services like a haircut. In many developed economies like the UK or the US, consumer spending makes up more than half of a country's GDP. The second part of the GDP equation is investment. This measures how much businesses spend on things like buildings, land, and equipment. It also includes a major consumer investment, buying a home. Investment can take a hit when the economy is suffering. You can see in this chart domestic business investment plummeted in the US during the financial crisis. That's because companies were trying to save money instead of putting it towards things like factories, machinery, and equipment. Okay, now we get to government spending. This is the money local, state, and national governments spend on things like roads, schools, and defense. Government spending varies a lot depending on each country's approach to public goods and services. Take, for example, France, where government spending amounts to roughly 56% of GDP. That's compared to 41% in the UK and 38% in the US. That brings us to the final part of the GDP calculation, net exports, or exports minus imports. A lot of countries have negative net exports, meaning they bring in more products than they send out. For example, the UK imports around $1 billion worth of coffee every year, but only exports around 315 million, meaning its net exports of coffee are negative. Countries around the world collect data on consumption, investment, government spending, and net exports. This makes GDP a universal measurement and a way for countries to stack up against one another. But it's not just the sum of the equation people look at. You'll often hear about the GDP growth rate, or the percentage change in GDP over time. Generally, if an economy is healthy, GDP growth expands. If an economy is in bad shape, GDP growth contracts. 2 consecutive quarters of negative GDP growth are referred to as a recession. But GDP doesn't always give a full picture of the economy. Critics say the equation puts too much weight on production and manufacturing, and not enough on services and the digital economy. Just think of Spotify. For $10 a month, you can listen to unlimited music from a huge range of artists. In the past, you'd have had to buy all of those albums separately, with each one contributing to GDP. It's hard to factor a digital service like Spotify into the GDP equation, which is used to measuring physical goods. GDP also doesn't measure economic equality and well-being. So even if a country is really rich according to GDP, wealth may be spread unevenly. Plus, GDP excludes unpaid work, like volunteering for charity or childcare, and it doesn't factor in costs like pollution or illegal activity. Some experts have come up with alternative measures to GDP that measure overall happiness and quality of life, but so far none of these have stuck. Maybe it's just too hard to put an economic value on that first sip of Morning Joe.
GDP is the total monetary value of all the finished goods and services produced within a country's borders in a specific time period. Gross domestic product tracks the health of a country's economy. Finished goods are goods that are ready to be consumed. Finished goods are available for sale in the market. The value of raw material is not counted in GDP, and the GDP of a country is calculated monthly, quarterly, and yearly. There are 4 components to GDP. The 4 components of gross domestic product are personal consumption, business investment, government spending, and net exports. That tells you what a country is good at producing. GDP is a country's total economic output for each year. It's equivalent to what is being spent in that economy. GDP is equal to C plus I plus G plus net exports, where net exports equals exports minus imports, and C equals consumption, or the value of all goods and services consumed. I equals the amount invested by companies, where companies spend money to build factories to produce goods. G equals government expenditure, where the government spends for paying salary to employees, for maintaining the army, running hospitals, etc. And exports equals the value of goods and services sent outside the country, less imports, which is the value of goods and services brought into the country. If exports is greater than imports, that country is a net exporter. If exports is lower than imports, that country is a net importer. Net exports impacts the GDP calculation of a country. This chart shows how the GDP of the United States has grown over the last 15 years. It was roughly $14 trillion in 2006, and it has grown to over $21 trillion in 2022. This growth in the U.S. economy is quite impressive, given the overall size of the U.S. economy. We can compare the GDP of 2 countries to compare the size of their overall economies. But comparing 2 countries' GDP does not tell us the whole story. For example, in 2022, the top 6 countries by GDP were United States at $20.9 trillion, China at $14.7 trillion, Japan at $5.1 trillion, Germany at $3.9 trillion, the United Kingdom at $2.7 trillion, and India at $2.6 trillion. But India, for example, is not as rich a country as, say, Germany or the United Kingdom. And the reason is because they all have very different populations. India has over 1.2 billion people, while Germany only has 84 million people. So we use another metric called the per capita GDP. Per capita means per person. A country's GDP, or gross domestic product, is calculated by taking into account the monetary worth of a nation's goods and services after a certain period of time, usually 1 year. It is a measure of economic activity. Then this amount of wealth is divided among a given country's population to calculate its GDP per capita. As this chart shows, there's a great deal of disparity in the per capita GDP of the top 6 GDP countries of the world. So the better measure of the wealth of the people of a country is indeed the per capita GDP. Let's look at the top 6 countries of the world by per capita now. The data on the left shows the top 6 countries in the world by GDP in 2022. The top 6 countries are the United States, China, Japan, Germany, the United Kingdom, followed closely by India. On the right, we list the top 6 countries by GDP per capita. They are Luxembourg, Singapore, Ireland, Qatar, Switzerland, followed by Norway. You will notice that none of the countries on the left are in the list on the right. The United States comes in 7th in GDP per capita, just below Norway. Let's take an example to calculate per capita GDP so we are absolutely sure we understand the concept well. Say you have 2 countries, A and B. A has a GDP of $10 million and the GDP of country B is $4 million. You will see that the GDP of A is 2.5 times larger than that of B. However, country A has a population of 1,000 and country B has a population of only 200. So country A is 5 times as populous as country B, but its GDP is only 2.5 times bigger. So, on a per capita GDP basis, A has a per capita GDP that is only half as much as country B. Remember, per capita GDP is GDP divided by total population. In the last section, we mastered GDP. Now let's look at taxes and how countries spend money on the G, or government, component of the GDP. We all pay taxes no matter how much we earn. But let's start with a video on taxes. Watch carefully.
To understand taxation, consider this short story. Once upon a time in a small village, there lived 2 friends. Let's name them Joey and Chandler. They both had their farm next to each other and were living a decent life. Then one day, robbers attacked their farms. Joey, being a well-built guy, beat the hell out of the robbers, leaving the robbers extremely thankful that they were alive. Unfortunately, Chandler was not so strong, and so he had no other option but to allow the robbers to steal his crop. Chandler knew he was not so strong, and to protect his farm from future theft, Chandler made a deal with Joey. He asked Joey to protect him from the robbers, and in return, agreed to give Joey 10% of his crop. This deal was signed successfully. The robbers attacked the farms at the next harvesting season, and this time, as per the deal, Joey gave a sound beating to the robbers and protected his and Chandler's farm. When other farmers came to know about this, even they agreed to offer 10% of their crop for Joey and their security. Joey decided to stop his farming business and instead recruited a few youngsters and trained them how to fight. The next time, no matter where these robbers attacked, Joey and his team fought and thrashed them. Robbers knew all the farms were secure, so they started looting other people, like traders. Soon, everyone from the village demanded security from Joey and his team and agreed to pay a portion of their earnings. Since they were from different occupations, they were classified accordingly. People who produced something, like farmers, were categorized into manufacturers. People who bought goods from manufacturers and sold it in the market were called traders. People who provided services like doctors were called service providers. People who had jobs were called employees. People who bought goods from manufacturers and sold it in other villages were called exporters. People who bought goods from other villages and sold them in this village were called the importers. Joey decided to call the amount paid by them a tax, and according to the categories, they were asked to pay the tax as follows. For manufacturers, a percentage of the production called the excise tax. From traders, a portion of their sales called the sales tax. From service providers, a portion of their charge called the service tax. From employees, a portion of their salary or income called the income tax. From exporters, a portion of their sales called the export tax. And from the importers, a portion of their sales called the import tax. But later, to maintain their profits, some manufacturers and service providers increased the cost of their product and services, thus indirectly transferring the tax burden to the buyers of the product. Hence, these are called indirect taxes. But the salaried employees cannot transfer their tax burden. They had to directly pay their taxes, hence they are called direct taxes. Later, Joey decided to levy the taxes on the profit earned by manufacturers and called them income tax. So traders, manufacturers started paying two types of taxes, the indirect taxes and the direct taxes. Soon, Joey became the king, and his village became his kingdom. People were paying taxes, the kingdom was flourishing, and everyone lived happily.
Taxes are mandatory contributions levied on individuals or corporations by a government entity, whether local, regional, or national. Tax revenues finance government activities including public works and services such as roads and schools, or programs such as Social Security and Medicare. Taxes are used to pay for people who work for the government, such as the military and police, provide services such as education and healthcare, and to maintain or build things like roads, bridges, and sewers. Collecting taxes is a fundamental way for countries to generate public revenues that make it possible to finance investments in human capital, infrastructure, and the provision of services for their citizens and businesses. Progressive tax is where the average tax burden increases with income. A progressive taxation system is one where the tax rate increases as the taxable amount increases. The term progressive refers to the way the tax rate progresses from low to high. And so, high-income families pay a disproportionate share of the tax burden, while low and middle-income taxpayers shoulder a relatively small tax burden. There are three types of taxes. Number one, on what we earn, either income tax or capital gains tax. If we earn salary or wages, we pay income tax. If we make investment gains, we pay capital gains tax. 2. On what we consume. When we buy something, we pay taxes on the price of the product or service we buy. It is called sales tax or value-added tax or VAT in different countries. But the price of the product or service is grossed by the tax we need to pay, and that amount is paid to the government on our behalf. And third, on what we own. If we own a vehicle or a house or land, we pay property taxes. Direct tax, as the name suggests, is paid directly to the government, while the indirect tax is collected by someone who passes it on to the government. Although the actual definitions vary between jurisdictions, in general, a direct tax or income tax is a tax imposed upon a person or property as distinct from a tax imposed upon a transaction, which is described as an indirect tax. Direct tax is levied on income, while indirect tax is levied on product or services. The burden of direct tax cannot be shifted from the taxpayer. In indirect tax, the burden of tax shifted to the seller. Direct tax is paid directly by the taxpayer. Indirect tax is paid by the person who collects it from the actual taxpayer. Direct tax is paid after the income reaches the hands of the taxpayer. Indirect tax is collected before the good or service is provided to the taxpayer. Collection of direct tax is difficult. Collection of indirect tax is relatively easier. There are multiple kinds of taxes. First, income tax. This is levied on wages and salaries. Second, payroll tax. This is a percentage withheld from an employee's salary by the employer, who pays it on the employee's behalf to fund Medicare and Social Security programs. Third, corporate tax. This is levied on a company's profits. Fourth, sales tax. This is levied on goods and services consumed. Fifth, property tax. This is based on the value of the property owned, such as a house, land, or car. Sixth, tariff. These are taxes on imported goods. Seventh, estate tax. This is applied to the value of one's assets that are inherited by the heirs at the time of one's death. So now that we know all about GDP and taxes, let's recap with the key takeaways. First, the GDP is a measure of the size and performance of a country's economy. Second, however, GDP per capita is a better indicator of how wealthy a country really is. And third, taxes are everywhere, and we need to know that under the federal law of the United States of America, tax evasion is a crime. Thank you for your time. Until next time then, stay enriched and strong.